Hello guys and welcome back to another video of Nova Forex. Are you facing the problem of market hitting your stop loss and then it hits your target? Then don't worry, as this video would help you solving this problem. So, in this video we would discuss about the inducement zones traps that are being set into the market by the smart money. And also after that we would discuss on how to get saved from getting into such types of traps. Now before we move on into the video, make sure that you subscribe to our channel and hit this bell icon to never miss out any of our upcoming videos. Now let us move on into the video. So, the smart money makes the inducement zone in order to trap the retail as well as the small institutions. Now let us first learn about the basics of the inducement zone and liquidity zones in order to understand the traps correctly. So, the inducement zone basically means the zone at which the retail as well the small institutional traders think that this is the best time to enter into the market, but the market hits their stop loss and then move towards their target. So, how do the market makers make them believe that this is the best time to take entry into the market? As we all know that the smart money knows about all the analyses that the retail traders and small institutional traders use, and thus, they manipulate the market to make them believe that they should enter at this specific point. So, let us see one of the example of how do they do this. So, here we have the Euro-Swiss francs chart on 1 hour time frame. So, as you can see here that the market is doing the break of structure to the upside, which indicates that the market is in an uptrend. And then we see market making these big bullish candles after reaching to this support zone for 2 times, and thus, the retail traders and small institutions would plot the support zone from this point and would place their buy limit order at this zone. Now let us wait for the market to come at this zone. So, as you can see here that the market respected this zone first by going a little to the upside, and then it went below the zone, which hits the stop loss of the retail traders as well as small institutions. Now, did you know why this happened into the market? So, in order to know this, we would switch over to the higher time frame. So, by looking at the left, we can see that the smart money made a demand zone here, and then it made a support zone in order to induce the retail traders and small institutions into the market. Now let us learn about why the smart money makes inducement zones into the market. They generally creates the inducement zones in order to get sellers or buyers into the market, as the smart money could not initiate their buy trade into the market if there are no sellers, and similarly, they could not take short position if there are no buyers into the market. And also, they do this to ensure that they buy the currency pair at lowest price and sell at the highest price, and vice versa while taking short position. The impatient traders often fall into such type of inducement traps. There are too many types of inducement zones which are formed into the market, which induces the retail traders and small institutions into the market. Let us see different types of inducement zones that the smart money makes in order to trap the retail traders as well as small institutional traders into the market. So, these are all the types of the inducement zones which we are going to learn in detail. The first type is the resistance level. Let us see an example of it. So, here we have the pound US dollar chart on 1 hour time frame. We can see market making a rally-based drop pattern here, and then it made a resistance zone as it rejected this zone for 2 times. Now the retail traders and the small institutional traders would get induced into the market as they would place their sell limit order at this resistance zone. And now that the smart money has got sellers who are ready to sell at this point, they would push the market to the upside in order to reach at this supply zone. And also, this would make sellers the buyers of the market as their stop loss gets hunted by the market. And then the market made this big drop. Now let us move to the second type, which is trend line. Let us learn about this type through an example. So, as you can see here that the market is doing the break of structure to the downside, which indicates that the market is in a downtrend. We can see market creating the pattern of drop base drop, and then it made a trendline liquidity above this candles. Now as we can see that the market has respected this trend line for 2 times, and thus, a lot of traders and institutions would set their sell limit order at this point. Now let us see how the market would react when it would reach at this point for the 3rd time. So, as you can see here that this was a trap as the market went above towards the supply zone, which hits the stop loss of the retail traders and the small institutions. Now let us move on to the 3rd inducement zone type, which is supply and demand zones. So, the supply and demand zones are those zones at which when the market comes, the market makes big bearish or bullish candles, as a lot of sellers and buyers have set their limit orders at this zone. Let us learn this type through an example. So, here we can see market making a rally, then a base, and then it dropped, which is why we would draw a supply zone at this point. Now let us see how the market reacts when it reaches at this supply zone. But the market did not respect it and went above it, and thus, we can call this as an inducement zone. Now let us see an example of the demand zone. So, here we can see market making a drop, then it made a base, and then it made a rally. And thus, we would draw the demand zone from the base. Now let us wait for the market to reach at this point. As you can see that the market did not respect this demand zone, which is why we can call this zone as an inducement zone. The scalpers and the impatient traders often fall into such a type of inducement zone trap. Now in order to get saved from getting into such type of traps, we need to identify the inducement zones and trade along with the smart money to maximize our profits into the market. Now let us learn about the liquidity zones of the market. So, firstly, what is liquidity? The liquidity basically means the area where there is big money. The liquidity zone is created in order to induce the retail traders and small institutions to initiate counter orders into the market, which is necessary as the smart money needs sellers to initiate their buy position into the market and buyers to initiate their short position into the market. The smart money creates the liquidity zone in order to induce the retail traders and small institutions into the market and then trap them by making this an inducement zone and bringing the price to the zone at which they have set their buy or sell limit orders into the market. Now let us see some of the types of liquidity zones. There are 4 types of liquidity zones, which are equal highs, equal lows, trend lines, and below or above supply and demand zones. The smart money mostly creates the equal lows or equal highs liquidity zone into the market as the scalpers gets trapped easily into such type of trap. Now let us see an example of how most of the scalpers as well as the small institutions falls into such type of trap. So, here we have the New Zealand dollar Japanese yen chart on 1 hour time frame. We can see market doing the break of structure to the downside, which indicates that the market is in a downtrend. And then we see market making a liquidity zone of equal highs as T rejected this zone for 2 times. Now the retail traders and the small institutions would set their sell limit order at this zone. Let us wait for the market to reach at this zone. The market went above this zone and thus, the sellers became buyers of the market as their stop loss was hunted. And then we can see market making a big drop. Now did you know why this happened into the market? So, by looking at the left we can see that the market made a drop-base drop pattern and thus, we would draw the supply zone from the base. And this equal highs liquidity zone was set to trap the retail traders and small institutions. Now let us see an example of equal lows trap occurring into the market. So, here we have the Euro-Japanese yen chart on 1 hour time frame. We can see market doing the break of structure to the upside, which is why we can say that the market is in an uptrend. And then we see market making an imbalance candle which did the break of structure to the upside, and thus, we would plot the bullish order block zone from this point. We can see market creating a liquidity zone of equal lows. And then, we see market sweeping this zone to the downside in order to reach at this bullish order block zone. We would initiate our long position from this point. And as you can see that we ended up making up a profitable trade. Now a question might arise into your mind that why the smart money wants to induce the retail traders and small institutions into the market. So, they do this in order to get the counter orders, which would also increase the liquidity into the market, and thus, it would help them in initiating their trades easily into the market. Now that we have learned about the basics of the inducement as well as liquidity zones, let us move on to the strategy that we can use in order to get saved from getting into such type of traps in trade along with the smart money for maximizing our profits. So, in this strategy we would find the liquidity zones and then we would wait for it to become an inducement zone by doing the liquidity sweep into the market. Let us learn this strategy through an example. So, here we have the Euro-Australian dollar chart on 1 hour time frame. We can see market doing the break of structure to the upside, which indicates that the market is going through an uptrend phase. And then, we see market going above after reaching at this zone for 2 times, and thus, the retail traders as well as the small institutions would place their buy limit order at this point. This time also the market went up, and now we can see it coming back to this support zone again, and now that the traders who had not placed their buy limit order would do it at this point, and those who would earn profits by placing their buy limit order at this point would buy more units at this point, which is why the liquidity would increase into the market. Now let us see how the market reacts after reaching at this zone. So, as you can see here that the market went below this zone, which hits their stop loss, and now there are sellers more into the market, and thus, the smart money could initiate their long position at any point of time. So, here we see market going above after reaching at this point. Now let us see the same chart on the higher time frame, which is 4-hour time frame in this case. We can see that the market has respected this higher time frame bullish order block zone as it went above after reaching at this zone. And this is why I recommend you to use the multi-time frame analysis while placing the orders into the market. This brings us to the end of this video. So, in this video we learned how the market makers induces the retail traders as well as the small institutions into the market to gather liquidity and how you can get saved from it. Now before we end this video, if you found this video useful, then don't forget to like the video and make sure that you subscribe our channel to never miss out any of our upcoming videos.